Welcome back to the Early Stage Investor, where we only cover assets that can have potentially life-changing returns. The most voted company for me to cover this week was Mega Uranium. I was surprised to see this. It's a tiny market cap, strange asset. It's not even really a mining company, but it has given investors life-changing returns before. In 2004, it went from 57 cents to almost 10. So it did like a 20x move from 2004 to 2006, right? So does it have the potential to make another life-changing move? We're going to dive into that. But first, we're covering Mega Uranium this week because it was the #1 voted asset. Keep letting me know which ones you like. This one won by 3 votes. So it's very easy to swing the decision on which asset I dive into next week. The goal is to get through all of the uranium companies because uranium is the new oil. The people that owned land in the Wild West of the United States, where oil was plentiful, got filthy rich when oil became massive. Well, uranium is powering the nuclear renaissance that is taking place. It is a global movement. Uranium is the new oil. So the assets that control uranium are going to be some of the most valuable assets on the planet, especially because they're still in the very early stages of massive growth. So that's why we're staying on top of uranium. And so with Mega Uranium, let's dive into it. Well, to start, it has a price to earnings ratio of 15. That is a very healthy price to earning ratio. What that means is they're earning 2 cents per share. The share is 31 cents. And so the price to earnings ratio is 15, right? It's 15 times the total earnings being generated per share. So that is very positive. That's a low price to earnings and is very positive that they're making money at all. So again, this is a very interesting company. What do? They have a property. The marine uranium molybdenum project is located approximately 32 kilometers away from the small regional hub of Georgetown, located in Australia. The wholly owned project is currently under option to Consolidated Uranium. So Consolidated Uranium sees potential in this piece of land. But this is the big game. This is really, if you buy mega shares, you are investing in the assets that they own, right? So these are the assets they own. As of March 31, 2024, March 31, 2024 is the most recent financials we have. So they have 19 million plus shares of Next Gen Energy. They have 9.3 million shares of Toro Energy. They have 1.4 million shares of Uranium Royalty Corp. They have 4 million shares of ISO Energy. They have 4.8 million shares of Atha Energy Corp. And they have 1.8 million shares of Premier American Uranium. So what they do is invest in deep value. So they see deep value in these assets. If uranium is the new oil, then they see just huge potential. It is a very interesting company from that perspective. So let's look at the financials to understand whether or not this company is overpriced or is a bargain, right? Well, first let's look at the balance sheet. So they have total assets of $238 million. They have total liabilities of $25 million. They have 10 times more assets than they have liabilities. So this company isn't going bankrupt anytime soon. It's going to survive. That is very positive. In terms of its liquid assets, they have 33 million current assets. That's what they could sell within a year to cover expenses. And they have total current liabilities. Those are the expenses they're going to have to pay within a year of $19 million. So they have about $13 million of extra capital, right? So very liquid company, very healthy company. Now, this is where it gets very interesting. They have $204 million worth of long-term investments, right? Now, this is in Canadian dollars. This is in thousands too, right? So it looks like it's 204,000, but it's really 204 million. That's Canadian dollars. If we convert that to US dollars, that is 147 million US dollars. Almost 148 million US dollars. So what is its market cap? $100 million. So if you buy this company, you are getting a massive discount on the assets they control. You're paying $100 million for long-term investments worth $147 million. That is absolutely a good deal. Now, there's a lot more to look into for this company, right? Because What do markets do? They look at the future. Is the team competent enough to do the right thing with these assets, right? Because if it's a totally incompetent team, that doesn't really matter how good of a deal it is right now because you're investing in the future decisions they make. But what's very positive is we can see as of September 30, 2023, they had 158 million Canadian dollars worth of investments. Now they have 204 million dollars. So they are stacking and building this hoard. They're also making a lot on capital gains, right? And so if we look at their income statement, where are their earnings coming from primarily? Well, they're actually not generating any revenue. Their earnings are only coming from mainly unrealized gains on their marketable securities of 584,000 Canadian dollars, realized gain on marketable securities of 403. So it's almost like a hedge fund that invests in uranium shares and they are realizing gains. So as the shares this company owns go up in value, this company books gains and makes money on them. So far, extremely interesting asset. If we look at the statement of cash flows, they spent $8.6 million in the purchase of marketable securities. Overall, a very interesting hedge fund that is investing in these assets. If you buy this company, you get these assets at a discount. So what does the future look like for this company? In December 2023, Mega received an aggregate of 400,000 common shares of Consolidated Uranium in satisfaction of an $800,000 contingent payment that Consolidated Uranium became obligated to pay in accordance with the term of its purchase of Mega's Ben Lomond uranium property. That is very positive for this company that they have a property that other uranium companies are paying them for. If it becomes a producing property, that is a major windfall for this company. So that is positive. Now remember how I showed you how this company had about $13 million net current assets on its balance sheet. What that is working capital. That's the word for that. Working capital. How much liquid assets do they have that they could spend within a year? Well, this is the history of it. This is very positive. What this means is the company has a decent track record and they have good financial management. Because going back to June 30, 2022, they have 13 million on their balance sheet. As of March 31, 2024, they have 13 million on their balance sheet. So they have consistently built up equity in this company. Again, we're betting that this team will make good decisions if we buy this stock. Clearly, it's a solid team if they've been able to do this for years at this point. Now, the company does not generate operating revenues from its mining operations. It finances its mining and discretionary investment activities through proceeds from private placements of its securities, margin borrowings, the exercise of its stock options by holders, and dispositions of investments. Now, they have done a good job of keeping the market cap low, of not diluting shareholders too much, of accruing equity in the company. Remember, there's way more value in this company than the share price is currently trading at. That is very positive. If we were to look at the balance sheet and their assets were less than their market cap, then it would mean that they've just been pumping money and diluting shareholders and the costs are getting out of hand. And so it's a financially healthy company. There's equity in it. They do dilute their shareholders occasionally, but it doesn't seem to be anything significant at this point. In fact, if they are diluting their shareholders, it seems like they're doing it the right way, meaning they're accretive dilutions. So as they print shares and dump them on the market, they're getting more value on their balance sheet per share that they issue. So that's called an accretive dilution. That's good. You want companies to use their shares to accrue more value to the existing shareholders. Now, remember, if we're buying this company, we have to understand the value of the big assets on its balance sheet, which are these stocks. This is massive. This shows that the company understands this space very well. This is the state of their equity investments. NextGen Energy, they spent 9.8 million. Now it's 204 million. So that is its biggest long-term bet. At the end of the day, if you look at their balance sheet, that long-term investment number is primarily NextGen Energy. Yes, they have about 30 plus million dollars of these other securities. And this is what they paid for all the other assets on their balance sheet. Very interesting, right? So they paid 34 million for Toro Energy. That's worth 4 million. They paid 14 million for ISO. That's worth about 14 million. At the Energy Core, they paid 6 million. That's 3.6. Other investments, 8 million, now 2.9. So really, the big winner here is next gen. If I were to look at this company, what I would say is it's primarily a leveraged, solid investment way to get exposure to next gen energy shares at a deep discount. The rest of these are smaller positions needed to cover their existing expenses. That's why the rest of these are in the marketable security section of their balance sheet, right? We have long-term investment, that's next gen. The rest is in marketable securities. That's more liquid. That's what they plan on potentially cash flowing as the prices rise to pay off their expenses. But this is the reality of the situation, right? As of September 30, 2023, they had $157 million in the balance sheet. Now they have $205 million on their balance sheet. So they're doing really well overall with their uranium investments. That's primarily next gen. So looking at this company, it is a leverage play. Instead of buying next gen, you could buy this company, and this one will massively outperform next gen because it's already selling at a deep discount to next gen. They have plenty of liquidity to cover foreseeable expenses. They're not going bankrupt anytime soon. They also have these other assets on their balance sheet, about 30 million Canadian dollars worth. So it's just a majorly current undervalued company. If they liquidated and sold the company right now, the shareholders would get like a 50% return if you factor in all the assets on their balance sheet and how the market cap is way tinier than the assets on their balance sheet. So if you believe in next gen, if you believe in these other uranium companies, if you believe in the thesis of uranium, then this asset could skyrocket. Now you do have to put your faith in the founders and the team of this company. It's like a hedge fund. You're buying a hedge fund that invests in uranium. So it's very interesting, probably not as safe as just buying like a uranium junior miner ETF, which is going to have plenty of upside, but you don't have to put so much faith in the management team. With this, you're not as diversified. Really, it's a leverage play on next gen, but you're not as diversified as buying an ETF like URNJ because you're diversifying your risk across like 20 different management teams. So if one makes a really bad decision, the rest are going to make up for it, right? So whereas this, you're hoping this team continues to make good decisions because they've done a great job for their shareholders. That's just the fact. They've accrued equity to this company. It's selling at a deep discount. It's in the deep value zone. They've done a great job, but you're betting that they're going to continue making a good job. Now, that's what you're doing with any company. But at the end of the day, it's hard to find something wrong with this company, especially when you're getting the shares at a massive discount. But you really do have to believe in next gen energy to like this investment because if next gen energy crashes, this investment won't be worth anything. So if you want me to cover next gen energy next week, I am happy to do so. Just let me know which one you want me to cover next week. But this one is also a buy, right? What we're noticing, because at this point, this is the fourth company I've dived into the financials for. What we're noticing is that so far they're all pretty high quality. Why is that? Because they have survived a horrendous uranium winter. So any of the quality assets that have made it through the uranium winter have been super resilient, super disciplined. So they're well positioned to take advantage of the next nuclear renaissance, which is already underway, which should take place for the next few decades. This company is a solid buy as long as you can believe in the team, which they have no reason to prove that they aren't trustworthy, right? So if they continue doing what they're doing, this asset should do extremely well and is well positioned for the next nuclear renaissance. But it all hinges on next gen. So if you want me to cover next gen, we'll do it next week. Another buy.